Most business owners have heard about the 20% business deduction, the QBI deduction, but almost nobody actually understands how it works. Who qualifies, who loses it, and why do some people get it while others don't? Let's unpack it all. In aviation, a waypoint is where you adjust course to stay on track. In financial planning, we call those critical financial events. I created this channel so that no matter what life throws at you, you can maintain the vision to see beyond the waypoint. So what is QBI? QBI stands for Qualified Business Income. It's a 20% deduction on the income your business earns, but only if your business is a pass-through entity. That includes sole proprietors, partnerships, and S-Corps. It's not a credit, it's a direct deduction against taxable income. So if your business earns $400,000 in qualified profit, you could be looking at an $80,000 deduction. So who qualifies? You don't have to be an S-Corp to qualify. A sole proprietor or single member LLC still gets it. The difference is that 100% of your net profit counts as QBI. With an S-Corp, your income is split. Part is W-2 wages and part is business profits. Only the profit portion gets the deduction. So why would anyone choose to be an S-Corp? The sole prop might get a bigger QBI deduction on paper, but they still also pay self-employment tax on the entire profit. With an S-Corp, you pay payroll tax only on your W-2 wages. The rest passes through as profit, avoiding that 15.3% self-employment tax. So yes, your QBI deduction might be smaller, but your total taxes can still end up lower. It's about control, deciding how much to take as wages versus profit. So how much can you deduct? In simple terms, you can deduct up to 20% of your qualified business income, but there's a catch. Once your income climbs high enough, the deduction starts to phase out. And how it phases out depends on the type of business you run. The IRS separates businesses into two groups: specified service trades or businesses, called SSTBs, and non-SSTBs. SSTBs are service-based businesses, so think advisors, accountants, doctors, consultants, and so on. Basically, businesses that rely on your personal skill or reputation. If you're an SSTB and your income is high, your deduction fades out completely once you reach the upper range. But if you're a non-SSTB, like a construction company, manufacturer, or real estate business, your deduction doesn't disappear. It just becomes limited by how much you pay in wages or how much property your business owns. So how it works in practice. Let's use a simple example. Say your business earns $400,000 in profit. If you're below the phase out range, you get the full 20% deduction. That's $80,000. Now, let's say that amount of income happens to put you in the phase out range. If you're a service-based business, your deduction starts to shrink. By the time you reach the top of that range, it's gone completely. If you're a non-SSTB, your deduction doesn't vanish. It just starts getting capped by wages or property. For example, if you pay yourself $80,000 in W-2 wages, your deduction is limited to 50% of that, or $40,000. So both businesses make the same profit, but the SSTB gradually loses its deduction, while the non-SSTB still keeps a portion depending on how they structure wages. Now, here's where things get interesting. Your retirement plan can move you into or out of the phase out range. If you contribute to a pre-tax 401k, you lower your taxable income. That might drop you back into the full QBI range, which increases your deduction. If you contribute to a Roth 401k, you don't lower taxable income. And because Roth contributions come out of wages or profit sharing, they can actually reduce the amount of eligible QBI. We ran the numbers in the highest federal tax rate and included Utah's 4.5% state income tax to land on a combined 41.5% total tax rate. At that level, to still qualify for QBI, you'd have to be a non-SSTB. If you had $100,000 in qualified business income, here's how it plays out. No 401k contribution would reduce your effective tax rate to around 33% because of the QBI deduction. If you were to contribute pre-tax into a 401k and we were to max that out, your effective tax rate drops to just under 10%. But if you were to do that same $70,000 contribution to your Roth 401k, your effective tax rate is actually 39%. That's the result of a reduced QBI deduction and no reduction on your taxable income. So that's about a 6% Roth premium. the extra tax you're paying that year to go to Roth. But context matters. If your business income was $400,000, the difference between no contributions and maxing out a Roth 401k is only about 1.5%. So it's important to look at each year independently, your income, your deduction limits, and where you fall in that QBI range. A lot of people think once you hit the top tax bracket, you automatically lose QBI, but that's not always true. If you're an SSTB, yes. Once you're past that upper range, it's gone. But if you're a non-SSTB, you can still get QBI even at higher incomes, as long as you're paying yourself wages or have depreciable property. For example, if your business earns $400,000 and you pay yourself a $40,000 wage, you can still take a $20,000 deduction. That's 50% of your wages, even if you're in the top tax bracket. That's one of the main reasons S-Corps can stay efficient for high earners. QBIs also reduce your state tax bill in most states. Here in Utah, that same deduction lowers both the federal and state taxable income. So the impact is double. When you model it correctly, the savings are more significant than most people realize. For year-end planning, here's the key takeaway. QBI planning has to be done before the year ends. Once December 31st passes, your taxable income is locked, and so is your deduction. But there's one exception that gives you a little flexibility. If you have a solo 401k or company retirement plan, you can make a profit sharing contribution in the following year and still count it for the prior year's taxes. That means even if your books are closed, you can look back and make that deposit to reduce last year's taxable income and potentially keep yourself in the range for the full QBI deduction. That's where tax strategy and retirement planning work hand in hand. Not all flights will be without turbulence, so it's important to make adjustments when needed. Like and subscribe for more videos on how we support clients in their financial journey, helping them see beyond the waypoint.